Welcome to the Q1 2023 quarterly commentary. My name is Lorenzo Pederzani.
And I'm Matthew Evans, and we are the two portfolio managers at Westmount Wealth.
The last quarter was a real mixed bag in terms of headlines and market data, and so we're here to provide a little bit of context on that. Certainly a recurring theme we saw was a lack of direction, so today's quote is, "Which way are we heading?" Matt, do you want to get us started today and give us a little bit of context of what happened this quarter?
So the big headline last year was inflation and interest rates. And during the first quarter of 2023, we finally started to see inflation starting to slow. This has led to a pause out of the Bank of Canada, meaning that they did not raise rates on their last meeting. Conversely, in the US, the Federal Reserve did increase rates. And that is actually starting to show in the economy, with two of the regional banks in the United States actually failing, as well as Credit Suisse out of Europe. This has led to expectations that the Fed may actually pause or actually cut rates moving forward later into 2023, which has led to the US stock market, as referenced by the S&P 500, finishing the quarter up 7.5%. Now, this headline number may look good, but if we look underneath the hood, the breadth of the rally wasn't that strong. If we take a look at the 7 large mega tech stocks and we actually remove them from that S&P 500 return, the return of the index would actually be flat. A large majority of that 7.5 was generated just from 7 companies. This is particularly concerning because we want to see more breadth in a rally, particularly during a recovery. While we're going to be watching the stock side of the portfolio very closely, bonds are looking quite attractive. With a large move in interest rates last year, bonds are finally starting to compensate investors with higher coupon payments. Now, this is rare because over the last 10 years, we haven't really been compensated to own bonds, and there's been a lot of interest rate risk embedded within them. So when we look at yields relative to the beginning of 2022 to where they are now, bonds look quite attractive. As mentioned earlier, higher rates are meant to slow down economic growth, and that is starting to show in the economy, with odds of a recession still quite high. With all of that, Lorenzo, why don't you walk us through how each asset class performed?
So it was a good first 3 months of the year for bonds. We saw the 3 bond indexes that we normally report on in our quarterly commentary up anywhere from about 3 to 3.5%. Those are the kind of rate of return numbers that we're used to seeing on an annual basis, in bonds over the last decade, but we're seeing that over a 3-month period of time. So certainly have not recovered from, the -9 to -13% losses that we saw last year in those bond indexes, but certainly trending in the right direction. On the equity side of things, we saw the Canadian index up 4.5%. We saw the US index, as Matt mentioned, up 7.5%, and the NASDAQ, the more tech-focused index, up almost 17%, and international developed markets outside North America up about 8.5%. But again, as Matt mentioned, our concern there is that, when we're looking at a market recovery, we want to see breadth. We wanted to see more than just one sector that's performing well, and so there's still some concern right now. Lastly, let's take a look at the alternative investment side of things. Those of us who follow us will know that we're big believers in complementing our stock and bond exposure with high quality alternative investments. We have an alternative income fund where we hold residential mortgages, commercial mortgages, private credit, and structured notes. That fund was up 0.3% last year. We use that as a diversifier to complement our bond exposure. And so in a year, as I mentioned, where bond indexes were down 9 to 13%, that helped protect our Westmount Wealth clients. We expect more good things from that fund this year. In the income space, obviously, with higher interest rates, we should see that translate into better returns, specifically in areas of lending like private credit. Now turning to the Westmount Real Asset Fund, where we predominantly hold private real estate and private infrastructure for our clients. The fund was up 1.35% on the quarter. The attribution there was predominantly attributed to our infrastructure positions. A lot of the infrastructure assets we hold tend to be able to pass through inflation as part of their contracts, so we'll still do well in a rising rate environment. Real estate, on the other hand, where you've got appraisal-based real estate, is lagging a little bit what we're seeing in the markets, the public markets right now in real estate, where you're seeing real estate prices dropping. So we had some decreases in appraisal valuation there, which helped offset some of the gains we saw on the infrastructure side of things. And lastly, our private equity exposure through Kensington's private equity fund, following up on a positive year last year, the fund is up a solid 2.5% so far year to date. So Matt, why don't you give us a little bit of perspective of our current sentiment on various asset classes?
So the three major asset classes that we invest in are bonds, stocks, and alternative investments. So with the bond side of the portfolio, we are favoring higher quality government debt. And we are less favorable on lower quality, high yield debt. If we go into an economic slowdown, the probability of defaults increase, and we want to be holding that higher quality debt where we're less prone to taking an impairment on one of those loans. When we look at the stock side of the portfolio, we're neutral on North America, so Canada and the US, while we're slightly positive on international developed markets, and that's largely driven just by valuations. International stocks are better valued than the North American peer set. Finally, in the alternative space, we are neutral on mortgages. As Lorenzo mentioned, as the cost of borrowing increases, we are compensated through higher payments on those mortgages, but so does the risk of default. So we're going to remain neutral on the mortgage side of the portfolio. Conversely, private credit. With some of the banking failures we're seeing in the United States, our private credit lenders are receiving better deal flow. What this means is higher quality deals, stronger covenant packages, and higher yields. That's a great place to be an investor right now. Some of the infrastructure we own represent critical pieces of the economy, and if we go into an economic slowdown, will still be utilized. Finally, private equity we remain neutral on in this interest rate environment.
So what's the bottom line? A lot of our clients have been calling us in the last few months and wondering whether or not we're heading into recession and naturally expressing some concern.
So we looked at the last 7 recessions in the United States as measured by the National Bureau of Economic Research. And we looked at how a balanced portfolio would have performed during that period. And the average rate of return was a -1. Now that's nothing to celebrate, but it's far from the financial ruin that many would expect. At Westmount, we believe that a highly diversified portfolio of stocks, bonds, and alternative investments should help smooth out the volatility during a recession, allowing the investor to reach their financial goals and stay invested. So if you have any questions or concerns, please reach out and we'll see you next quarter.